Question from a user asking, how do I go about looking at charts technically using a top-down approach? Now, it took me a while to answer this question because I was thinking, where do you really start? Technical analysis has a lot of different layers. However, there are, quite fortunately, some of the most obvious tech is also some of the most useful tech. So it's not one of those scenarios when you've got to go through the rabbit hole to understand complicated tech before it becomes useful. Actually, tech becomes very useful very quickly. So here's a very simple approach, just using basic trend lines and support and resistance. And you can get a lot of benefit from just using those areas. So you can see here, first of all, if you want a top-down approach, first of all, you want to look at the monthly chart. And if we just look at the last couple of years, few years trading, we can see straight away that gold has a strong rejection of this $2,000 an ounce region. You can just see it here, the tailing action there, tailing action there, tailing action there, tailing action. And you can see as well that gold, look, it's in a clear uptrend. You can see it's trading above its 100 exponential moving average and its 200 exponential moving average. And it's also in a potential range, and it's towards the top of that range. So first of all, you've got quite a few clues, and you can see there's stiff overhead resistance from above. Now, if you just drop down to the weekly chart, let's see what we can see now. Okay, we can see those $2,000 out, that clear overhead resistance area. We can also see that the gold chart is still in an uptrend on the weekly chart as well. We can see we're making higher high, higher low, higher high. Now you can see this lower low hasn't taken out that previous higher low. So you've got a near-term downtrend that's trying to take control. You can see here we had a potential trend line break there. That's a big level. You've got a potential trend line break, and you've got to retest the area and sell off. But notice price hasn't moved back below that higher low. So straight away you can see that there's a near-term downtrend that price is in, but over the medium term, the broad uptrend still remains, and that low and this low have not taken out that significant low here from March 2023. You can also see that there's a big support level around that $1,900 an ounce. So you can just see, just visually looking at the charts, you can see, okay, you got swing point, swing point, swing point, swing point, and you can see that there's a clear support level just around that 1880 region and just that 100 exponential moving average. Now, going to the daily chart, now you can start to see that price has been flirting with the 100, 200 exponential moving average. And there's really a battle to see whether the bull trend is still in place. We had a breach of the 200 exponential moving average and then rising above the 100 exponential moving average. And then we've had a test of the 200 exponential moving average on the daily chart, just showing that support level in the near term, holding that near term support level, just holding around that $1,900 an ounce, around the big round number. So now, they're the sort of big levels. Now, the big levels are important. So what fresh big levels could I put in here? So the big levels now that I would see as very important is this potential trend line here. This is just keeping prices in that downtrend from May. So before we can sort of say the bullish momentum that is in the longer charts has continued, we want to see gold prices break out of that 1940. So if we see prices break out above that 1940 and say, the Fed next week on the 20th of September are really dovish, they said that's the end of rate hikes and, we're considering rate cuts. They're unlikely to say it like that, obviously. But if they start signaling that, you'd expect yields lower, dollar lower, and gold, you'd expect it to break out. And this could become an obvious reference point. You stay above this, stay with, get out, get below, get out, and then you've got that big round number, that $2,000 an ounce region, that big overhead resistance would be an obvious take profit area, and or if that broke that region here and price made fresh highs above that 2085, that does open up the region, for 2,100 and 2,200. So that's just a sort of example how using these big reference points helps, and it helps. Let's say, for instance, you had a bullish bias on gold, okay, and you're thinking, well, where do I want to put my stops? I don't want to have an unlimited risk, so maybe I'll put my stops underneath 1850 because I know that if that major support level breaks, I know that I'm really wrong about my trade. Or say that I've got this big trend line and I want to buy gold, but I'm only going to buy gold when this big trend line breaks. If I stay above, I'll stay with the trade. If I get back below, I'll exit the trade. I can use that as my reference points. That way, you see, the reason I use tech is just to define risk. That's all it is. It's just to think, where can I limit my risk? How can I get out? Where do I get in? It's a way of trying to limit your exposure to the market so that you are as tight as possible, but not tighter than necessary. If you're too tight, you start putting stops in here around the 1900, and you are bullish, you're going to get stopped out. Whereas, if something fundamental has to change for that 1860, 1880 region to break. And if it does change, then you want to be out because you don't want to be holding on to something unnecessarily. So there's a lot more that I could say, obviously, right? I'm aware of that. But this is just meant to be a little bit of an introduction of how to start using technicals for a top-down approach to define, limit risk. You can also use that for targets. And you can see it doesn't have to be complicated. And, in some ways, the simpler tech and the more obvious it is for everyone around the world to see, and the stronger the fundamental shift, the bigger the tech, the easier the trade is the general rule of thumb.